right, we're back. Paul, how you doing?
Good, man. What are you doing?
Oh,
Other than this.
Other than just recording a podcast on a beautiful Thursday afternoon. We got construction going on in the backyard, putting the patio in, so that'll be nice.
Nice.
Enjoy the last month of summer and the first month, maybe two of fall. That'll be nice to have out there.
Fall starts up there in August, right?
Yeah. It's so weird. I mean, September could be super hot or start to get cold.
Sure.
And it'll go back and forth for weeks, and then it settles on cold. That's it.
Yeah. I guess the only real update I have is I got to go out to Tennessee and see the construction of our home.
Yeah.
And it was about 75% framed, I would say. So
Nice.
That's coming along nicely.
Yeah, I saw the pictures, so I'm ready to be invited out there for the housewarming.
Yeah, you bet.
Yeah. Well, nice, man. Well, hey, everybody, we are previewing a couple videos that we just put together for our new website, thewealthwarehousepodcast.com. So that is going to be a site that you can send your friends to, your family. You can jump on there. Maybe we'll continue to add content to that site as well, but that'll just be a good place to send people and have an introduction to what this is all about. So we just recorded a few videos. There'll be some videos to watch on that website. And of course, the resources that we always tell people to go out and dive into. So we are just going to play the first couple videos as this episode, and then you guys can jump on the website and watch them again. We do go through a couple slides, so you won't be able to see the slides on the podcast or the YouTube version of this podcast episode, but or actually you will on the YouTube version.
Yeah, you'll be able to see it.
Yeah, well, it's getting really loud out there. I don't know, they got the leaf blower going or something.
Yeah, going nuts.
Yeah, so we better hang it up. So, all right, everybody. Well, hey, enjoy the next episode, and we'll see y'all next week. Hi, I'm Dave.
And I'm Paul.
And we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. Hey, welcome to Wealth Warehouse. I'm Dave.
And I'm Paul.
And we hope you enjoyed that first video where we spent about 4.5 minutes just discussing an overview of what the infinite banking concept is. In this video, we're going to be discussing the problem. Because as Nelson Nash says, if you don't understand the problem, the solution just doesn't matter. So with that, we're going to share my screen here with you. This is a quote from Nelson's book, and it's one of the foundational principles everybody should understand, that you finance everything you buy. You either pay interest to somebody else, or you give up the interest you could have earned otherwise on that money. So, Paul, why don't you talk about this slide here?
Thanks, Dave. Yeah, so this is a diagram that we call, the debtor. And you have the black line that represents the $0 line, right? That represents zero. And you can see the debtor goes into debt when he goes to buy something, right? So he's going to buy, or you're going to buy a car, for example. Well, you go into debt. Most people finance their vehicles or they lease them, right? So you go into debt, and then those little steps represent your paying back that loan over a period of time, let's say 5 years. And then you rinse and repeat. Most people trade in the car, they get a new one, and the process repeats itself over and over for a lifetime of purchasing cars. So it becomes a huge problem when you realize how much interest you're sending somewhere else.
Yep, you start at the zero line, you go below it, and work your way back to zero, which is really opposite of the saver, where you start at the zero line, you save up cash to buy that car, and then you take that cash, you take it to a dealer, give the dealer the cash, you get your car, and then you drop right back down to the zero line once again. Either way, between the debtor and the saver, you're still ending up at zero at the end of the line, at the end of the day, no more cash.
Yes, that's right. And then I would say that those of you familiar with the Dave Ramsey strategy of paying cash for cars, that's exactly what it looks like on a diagram.
Exactly. Where at the end of the day, you're back at zero, starting over, unable to earn any interest on those dollars ever again because you gave them away. But what if you could leverage every dollar and give it more than one job at the same time? Well, then it would look more like this, where you're going to start at zero and you're going to incrementally build it up. So you're acting as the saver. It's kind of combining saving and debt and controlling the entire equation, because you'll never end up back at zero because you're never actually taking your money out of the system. It's in there constantly earning and compounding in the background while you're using it at the same time somewhere else. We call that the wealth creator. So let's stop that. And, you know, there's a lot of problems with the current system. And Paul and I talk about this in the podcast constantly. You know, some of those problems are really the main one when it comes to this concept is lack of control of the banking function.
Right.
It's just a lack of control, which is why we always advocate control your capital or somebody else will, because currently somebody else is playing banker in your life and that person's not you. So you want to grab control of that function in your life. You know, what are some other problems?
Well, I think I think most people just have a lack of financial literacy. You know, we're taught from a very young age, you know, to do this or that with our money. And I think the most popular thing to do today is just to reference, you know, the 401k program that was, you know, created by the government. And most people are familiar with that. And that's where most people put their money for the future, right? Retire, you know, quote, retirement. But they don't really understand what's going on. And I think, and that used to be me. And that is why we see just across this country, people are in dire need of access to their capital now, not 30, 40 years from now. They'll need it then too, but they also need it now.
Absolutely. And we've talked to, I mean, we have hundreds of clients, and we've encountered multiple situations with clients who spent years, sometimes decades, piling their capital in a 401k. So locking that up where they don't have access to it until they're 59 and a half, right? And also at the same time, they're being taught to pay their mortgage down as quickly as possible, make extra mortgage payments, make extra payments towards your principal, put a big down payment on that house. So then something happens to the house, say it gets flooded, and now you've got to renovate. Well, are you going to be happy you had all that capital inside the walls of your house? Or are you going to wish you had access to some of that so you could do maybe renovations above and beyond what the insurance company is reimbursing you to do? Well, where are you going to get that capital? If it's in a 401k or a qualified plan, like Paul, you just said, government created plan, you're not going to have access to that without jumping through several hoops and potentially paying penalties and taxes when you take that capital back out.
Right. It's almost like the system it's not made for us or for you. It's made for them. And I think that's critically important to think about. And they recently, Dave, we just saw that little article that I had posted where they just changed some rule again where, you know, if you're in dire need, you can take $1,000 out of your 401k for emergencies, you know, as long as you can prove the emergency. Well, folks, or how often is there a $1,000 emergency? Generally, emergencies are going to be 5-figure emergencies.
Oh, for sure. Because a $1,000 emergency, you could probably put it on a credit card and
right, and
pay that the next month when that bill comes due.
Right.
You know, that's new tires. You need new tires on the car.
Right.
But a true emergency, you're going to need access to a lot more capital. But really, I think one of the biggest issues is they made it so easy. And when I say they, I mean the system. They've made it so easy for you to just take money out of your paycheck and put it somewhere and abdicate responsibility for that money and the growth of that money to somebody else, somebody who doesn't know you, likely doesn't care about you, doesn't have your best interest at heart, and certainly cares less about your family's financial situation than you do. So by abdicating that, we just hit the easy button and, okay, employer, automatically deduct money, put it somewhere, and 30, 40 years from now, I'll worry about that and hope it's enough for me to retire on and live another 30 years on what I've earned over there, which is a pretty crazy and even ludicrous idea if you think about that, that you're going to be able to put enough away to live another 30 years at the same quality of life that you're living now.
Right.
It's unfortunate, and it's a lot of, in my opinion, following the crowd, because that's what everybody else is doing. So
Yeah, I
if I
remember
do what
thinking,
everybody else does, then I'll end up where everybody else is.
that's right. And that's why we like IBC, because we're going to end up in a different spot. But I remember you just described what I was doing. I didn't know anything else, different to do with my money, and filing money into those government qualified plans. I didn't have a ton of cash just sitting around for emergencies. I really didn't, despite, Tammy and I were doing very well. So, that was a 2-person working household. So I can imagine, a 1-person working, the problem's even worse.
Yeah, right. There's only a single point of failure there. Well, so let's look into a little bit more deeply one of the problems with, what are most people familiar with, the 401k. So let's take a look at that, and maybe some things that you haven't considered before or nobody ever told you. One there, starting at the bottom left and going clockwise, you take 100% of the risk and you have 0 guarantees. Now, granted, there are people who maybe get this benefit offered to them without them having to put any money into it themselves. That's rare, but one class of professionals I can think of would be, professional airline pilots, who that company, just part of their union deal, the company puts money towards a 401k for them. Great. That's excellent. Good for you. And I'm glad you have that opportunity, which means maybe you should look at putting some of your other capital somewhere else, adding something else to that portfolio. But you take 100% of the risk without any guarantees, and you don't even get 100% of the return. What else?
No, you don't.
Yeah. So then you have what? Inflation.
Well, you have inflation, right? You have no idea really if your portfolio is going to keep up with inflation all over it. And most people have, again, going back to control, most people have, by doing that, you're ceding that control, right? So you don't know the money manager. You don't know, most people just don't, they just set it and forget it, don't they, Dave? And they don't realize what it's in, what the type of funds, and they can't even tell you. They just really blindly hand the capital over month after month after month, year after year after year, and hope, right? Hope that they have enough to eventually enable them to stop working.
Yeah. Right. That's hope is a great breakfast, but a poor dinner. Is that the quote? It's good to have hope at the beginning, but if that's all you're relying on, I hope you have something else on your plate than just hope.
Right.
Because you can't spin hope. How about average rate of
Hope
return?
is not a method, I think, is the old saying.
Yeah, that's not a good planning method. Average rate of return does not equal actual rate of return. So, we could have an actual rate of return of 0, but an average rate of return of 50%. I can show you the math on that. Average rate of return is is an average over time. It's really not enough to plan on.
And and the reason you bring that up, Dave, is because that is often what is advertised on television or whatever, or people out there in the wide world, the Dave Ramseys of the world are saying that, the average rates of return. That's what is advertised. But you need to go check and calculate yourself. What was your actual return?
Yeah, which is sometimes shockingly less than what you would have expected.
Correct. That's right.
There's always hidden fees. Not many people understand what they're paying in fees, and how that fee, what maybe it's 1% 1.5% per year sounds really small, but over the course of time, that eats up a gigantic chunk of your overall return. So, and then this next one, government controls your 401k. That's probably one of the biggest ones, and we'll talk more about that as we go on. But what's the problem with that, Paul?
Well, they can change the rules at any time, and they have. We're recording this in mid 2024, and we had what occurred in 2020, and we saw rule changes, and we're still seeing rule changes when it comes to the 401k, and we will continue to see rule changes with the 401k. So it it becomes a problem when we need to ask ourselves: are the changes to the rules advantageous to us or advantageous to the system?
Yeah.
And if you listen to us, you know what we know and think. It's the system. It benefits them.
And if this is the only thing in your plan, are you okay with them changing the rules 15 years from now, or right when you retire, and you have no say over it?
Right. It's like changing. It's changing the rules. If this is a game, halfway through the game or in the seventh inning, we're gonna, it's only going to be 2 strikes now instead of 3 strikes per inning or per batter or whatever.
Right.
So you have no control of that.
None. In retirement, every day is Saturday. So I've spoken to my mom, and she's been retired a few years now, and it was funny. At the beginning, she thought I would spend a lot less money than I actually do in retirement. I didn't think I would keep spending this much money, but I do. Because why not? You've earned it.
Right.
Those are your so-called golden years. So you want the license to spend more money. And that's
Sure.
the great thing about infinite banking. It actually gives you a license to spend more in retirement. And we hit on that in the podcast all the time.
Sure.
Next, you can't touch your money until when? There's this magic window when you can actually touch it, right?
Yeah, it's still 59 and a half, and there's a few exceptions to that. But we're in our mid 40s. I don't feel like waiting another 15 years before I can access my capital. But most people, most Americans that have a government qualified plan are going to have to wait till they're 59 and a half before they can start taking money out of it without penalty. And depending on what type of account it is, there's going to be some tax. So don't forget, if you have all your money in this taxable bucket, you're going to be in trouble because you're counting on that income. And like you just brought up with your mom, like you want to be able to spend what you saved.
Exactly. And you have no idea what the tax brackets are going to be, what the tax rates will be, which one you'll be in. Ideally, hopefully you won't be in a lower tax bracket, because why would you want to plan to make less money or live on less money at that time than you do now? So those are a lot of unknowns.
But that seems to be their prevailing attitude, isn't it? That, oh, don't worry, you'll be in a lower tax bracket. Well, they don't know that, right? We don't know that. But again, it means that they've lowered tax brackets, which they won't. Look at the numbers. We're going to have to pay for this debt somehow, right? So tax rates will go up, and you have no control over what they do.
None. So, and right now rates are historically low.
Sure.
So maybe there's an argument to be made. Hey, just get your taxes out of the way now while you're working and making an active income, so that you can enjoy the tax-free income later on when you have no idea what it's going to be and how much you're going to be pulling.
And I think you're spot on, Dave. Just to expand on that, if we think tax rates are going to go up in the future, why would you defer them to when they're going to be higher at a later time? That doesn't make any sense.
No, none. So anyway, that's a bit of the problem. And again, to go back to the beginning, if you don't understand the problem, the solution doesn't even matter. It could be staring you in the face and it doesn't matter. So hopefully that helped enlighten you just a little bit. In the next video, we're going to get to the real fun part and start talking about the solution to the problem. So stay tuned. All right. Well, in this video, we're going to talk about the solution. So we just spent 15 minutes talking about the problem, which you have to understand. But now the next step is, okay, I get the problem. What do I do about it? Well, let's talk solution. Paul, our our motto at the end of every episode, we state it, plain as day: control your capital, or somebody else will. And to us, this whole concept is about controlling your capital. We allow our capital to be controlled in so many different places, by other banks and bankers, by financial institutions, by the advice of financial entertainers telling us to give our money away to somebody else or give it back to the bank faster than they're asking for it by making extra payments towards our loans, or paying cash, giving all my capital over to a car dealer so I can have a hunk of metal that's going to depreciate in value over time. So, but yet none of that capital is going to be under our control. We're always going to have to ask permission to borrow it back, where you give it back, you give it to the bank, and then you go to the bank and say, may I have some of my capital back, of some of the equity in my home? Can I have a little bit of it back, please? And do they always say yes?
No, they don't.
Nope. Even if your income supports it, even if your income supports the ability to repay that home equity line of credit, we've had many clients over the years who've got lots of equity in their homes, but they go to ask for a HELOC, and the bank says no for one reason or another, and they don't know why. Right. Controlling your capital, having access to capital somewhere when you want it or need it for opportunities or emergencies or just to finance the things of life, is one of the most important things you need while you're alive, is that access to capital.
Yeah. Spot on, Dave. So another one is, and we're going to bring it up, we talked about it briefly in part 2, but in part 3 I'm going to bring it up again, because it applies to most people, is the 401k. When you are piling money into qualified plans, and you can talk, we're going to say 401k, but I mean any government qualified plan, you're really in business with the government. And I don't know about you, but that's the last group that I want to be in business with, right?
Yeah, pretend you had a friend who lied to you all the time.
Right.
They lied to you constantly. They never apologize when they lie to you. They always make excuses. And then they lie to you even when the truth would do them well, would serve them well. They would still lie to you. Would you still be friends with that person and give money to that person or do business with that person? Then why do you keep doing it with the government?
Yeah, it's weird because you always have to tell your friend like how much money you owe them at the end of the year. You can't just ask them, well, how much money do I owe you? And they're like, well, you have to send me all these papers and then I'll tell you. Or no, you have to tell me how much you owe.
You have to tell me, and if you get it wrong, you're going to be in trouble.
You're going to be in trouble. So again, just pick the right business partners. You want to be in partnerships with like-minded individuals. You want to be in partnerships with like-minded companies or entities, right? And that's, again, this mindset of becoming your own banker and how Nelson saw it, right? That's what we're getting after. So a healthy distrust of government is good.
Yeah, it is good. And the founding fathers believed that too.
Yep. Right. Exactly right.
Yeah. And they put it down on paper. So the solution then, if you want capital under your control, is to start capitalizing your own system. So the system that we promote, which if you're watching these videos, you're probably understanding that we're using a product to promote this system, which is dividend paying whole life insurance that's specially designed to accumulate capital very quickly and leverage that capital and always have access to it while it's compounding in the background at the same time, even while you're using it somewhere else at the same time. So putting your dollars to work in two places at once. One of the common misconceptions, Paul, is people say, well, I'm going to start doing that when, or I'll start doing that if I get that pay raise, when I'm a little bit healthier and I got a little more money and a little fewer things going on in life.
Right.
So what do we say about people who say, yeah, I'll do that when I have more money?
It makes me think of when we're all deciding to have children, right? Start a family. There's never a good time to do it,
You're never, yeah. When are you ever ready? Right?
right? You're never truly ready. So the best thing to do is, and this is what my wife and I did, we just started, right? And I would say the same thing to people that are on the fence. Listen, the best time to plant a tree was 20 years ago. The next best time is right now, right?
Absolutely.
You don't, those misconceptions. Another one is, I got to be wealthy. And I think we're going to talk more about that, but no, you don't. You're going to start where you're at, right?
Yeah. You start where you're at, right? It's all about paying high premium relative to your income. So everything in wealth is relative. You could have one person paying $5,000 a year in premium, and that's a whole lot of money.
Right.
And they're a great client because they understand it, and they're a great, practitioner of the infinite banking concept because they're paying high premium relative to their income. Somebody else making a lot more money, paying 5,000, they're scared. They're scared to capitalize. They're afraid to capitalize. And they're going to be sorry down the road when they need access to capital and it's not there for them. So there's a lot of great things about this concept. If you listen to the podcast, you'll hear them all. You'll also hear, you hear the pros and the cons, both. But let's take a look at what we would consider to be a lot of the problems out there. And we talked about the problems last time. In this episode, in this video, we want to talk about the solutions to all these problems. So look, we probably hit on a lot of these last time, not all of them, but volatility in the market, taxes, of course, which we did mention, access, guarantees and risk, and control, and all these other things. Well, the great thing about this concept is there's a solution to every one of these problems you see here in red. There's a solution in green that the infinite banking concept can solve through the use of properly designed whole life insurance policies.
Right? Properly designed for you, right? Because might look different than mine. They might look different than Dave's, but properly designed for you and your family.
Absolutely. So what are a couple on this list, Paul, that really stick out to you as some of your favorite your favorite benefits of practicing infinite banking?
Sure. Well, anytime I can save money on taxes, on income taxes, that's a win for me. And I think everyone would agree that yes, if I could pay less taxes and pay no taxes on my savings and my capital that I'm accumulating, that would be a great attribute of a product that I'd want to own as much as I can.
Absolutely. And the great thing about this is all those earnings are accessible inside your policy tax-free over your lifetime. And then what's going to happen when you, as Nelson says, graduate from this earth, that day when you're gone, you walk out, what happens then?
I walk in with cash.
With cash.
Tax. With,
yeah. Income tax-free cash. Absolutely. Your family, they'll still be upset. Let's be honest. At least you hope they will be.
Right.
If you've lived a decent life. But they're not going to be struggling financially. They'll have room to breathe.
Yep. And if I had to pick another one, Dave, for me, right below it, liquidity is opportunity. And I don't mean necessarily, it might not be a profitable opportunity, but it might be an opportunity where, like you said earlier on episode 2, my basement flooded, or my house caught on fire, or I had a major expenditure that was not anticipated. Well, I have an opportunity without interrupting the growth of my capital to pay for that thing so that life can go on. I don't have that with other government-sponsored qualified plans. I don't have that flexibility.
Right. Yeah, as Nelson says, capital attracts opportunity. And you and I have seen this in our lives. I've been practicing this concept for a decade and a half. And you were introduced to it several years ago and jumped on it immediately and started paying significant premium. And as we've accumulated capital, more and more opportunities have come our way, which have, I'd say I'm in such a better position now than I was 15 years ago. I'm in a better position than I was 5 years ago, and I'm better off than I was 1 year ago because of the access to capital and the opportunities it's provided. And it seems to get better every year as we continue and keep building our system and adding more policies and paying more premium for this, because we know what that end result is and we know what it's going to do along the way.
Yep. And Nelson said that, right? This, whole life insurance gets better every day, no matter what is going on.
Absolutely. There's nothing you can do about it.
And there's nothing you can do about it. It's going to get better every day, every year, and that's why we keep buying more and more of it, isn't it?
Yeah. And what goes into that is also thinking long range, because we're not thinking 1 year from now, what's this policy that I'm just starting today? What's it going to look like 1 year from now? Well, that's not near as important to me as what it's going to look like 10 years from now, 20, 30 years from now. That's really important to me. I can take the upfront hits, as you might call them, because you're not going to have access to 100% of what you put in the first few years. So you have to be able to see past that and think long range. This is one of those things where as long as you stick with it, you cannot lose. You'll get back everything you ever put in and then some.
And then some, many, many times over. Yeah, if there's, and we haven't talked about the pros and cons, but we do have an episode that covers it, but it's a temporary sacrifice of liquidity. But in the grand scheme of one's entire life, of adulthood, age 40 to age 80, you have you have a little bit of a sacrifice of liquidity early on, and then as you practice IBC, you don't even notice it. It's not even something that I think about.
Yeah. Well, if you think about it, anywhere you put your money, anywhere you plant it so it can grow, you're going to have a lack of liquidity.
No question.
Like when you're funding that
Absolutely.
401k, even that Roth
Yes.
IRA, anything else, your TSP, you don't have access. There's a loss of liquidity, right?
Yeah, I've sacrificed a ton of liquidity.
Yeah, right?
Right.
This is no different, except that you'll actually have access to a decent chunk of that immediately. You don't have to sacrifice all of that, even though all of it will be working for you. Building that, one thing we haven't even really mentioned is that permanent death benefit. That death benefit that's going to get bigger and bigger every single year. Just like you said, it gets better every year. There's nothing you can do about it. That includes not just your cash value accumulation and the growth and the dividends, but the death benefit gets bigger and bigger. So the longer you live, the more you leave.
That's right.
Yeah.
More death benefit, more cash value.
100%. So we could talk so much more about the solution and the benefits, but we'll go ahead and cut it off there. There's going to be plenty of podcast episodes to dive more into that. In the next episode, we'll talk about who this is for. Is this for you? And if so, how do you get started?
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle in a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.